Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. Hello, I'm Michael Bull. Thanks for joining us on one of the 42 radio stations, iTunes, YouTube, or the show website, commercialrealestateshow.com. Well, today we have a great topic for you. It's senior housing. You know, with baby boomers coming of age, the change in lifestyles, and the impact of technology, there's certainly a lot to talk about in the world of senior housing. And first, we're going to take a look at the investment side of the industry. Please welcome Ryan Severino. He is Senior Economist with REIS. Ryan, thanks for joining us.
Hello, Michael. Good to be with you again.
Well, you too. Thank you. And Ryan, to start us out, you know, how has the senior housing sector been performing so far in 2015?
You know, we're still in the process of finalizing our second quarter numbers, but I would say that overall the sector's been performing well. The overall vacancy rate's down nationally to about 8%, and each of the major subtypes, at least that we track, assisted living, independent living, skilled nursing, and memory care, have all seen vacancy declines as of late, relatively strong vacancy declines as of late. Moreover, rents are continuing to grow. You know, we've recently seen rent growth, depending upon which subtype you're talking about, in the 1.5% to 2.5% range. And so the fundamentals are looking pretty healthy at this point overall.
And that rent growth, what's that trend there? So is that in the last quarter or the last year? Or?
That's year over year. Okay. So we're seeing, you know, something inflationary to slightly exceeding inflationary over the last, say, 12-month period that we have finalized data for.
Okay. And to put it in that perspective, how does that look from, say, maybe recession days to now?
Clearly, we've had a strong bounce back since the recessionary days. For the last couple of years, I would characterize performance as being strong. Overall, we've seen vacancy declines of more than 100 basis points for, again, properties overall in each of the last 2 calendar years, which I would argue that's a strong showing that it really is the envy of some of the other major commercial real estate sectors. Certainly we haven't seen that out of office or retail, for example. And I think this year really has the potential to be that good. I think it's still a little bit early in the year. We need to take a wait-and-see approach. But I think, you know, alluding to some of the drivers that you talked about, they're still in place, and we see no reason why that shouldn't persist for 2015 as well.
Okay. Well, some of these improvements in performance in the market, Ryan, is some of it, you know, based on the baby boomers coming of age, or is it more based on the economy and more people be able to afford it?
You know, it's really a confluence of both. We have seen demand for property types increasing along with the macroeconomy, which I think is, you know, that is very straightforward, relatively easy to understand. And I think, you know, you're starting to see some of the baby boom generation consider this. We're really on the front end of that demographic wave with the consideration that the baby boom generation begins in 1946. And so the front end, the baby boomers is turning 69 this year, and that's around that inflection point, kind of late 60s to early 70s, depending upon what part of the country you're in, where you start to see more and more people transitioning into a facility like the type that we're discussing today. Okay,
and if from the outside looking in, I think a lot of listeners and viewers might think that, you know, the outlook for senior housing has to be great, right, with these baby boomers coming of age.
Yeah, I think our outlook moving forward is relatively optimistic. I think in the short to medium term, you know, we expect vacancy to continue to decline, probably, you know, somewhere around the same pace, give or take, that we've seen over the last couple of years. I think rent growth will actually accelerate a bit as the market continues to tighten. I think, knock wood, in the absence of a recession, which, you know, I'm not assuming is coming tomorrow, but economics is a cyclical thing. There's no reason to expect that we should see a reversal. There are some, you know, pockets of construction where it's I wouldn't say frothy, but we're starting to keep an eye on. But that's more of a you know, a medium-term issue than kind of a shorter to medium-term issue at this point.
Okay. And what are you seeing for cap rates for some of the various property types, Ryan?
Boy, you know, it's become incredibly robust, especially for good quality properties. And you know, as you well know, it's not isolated to seniors housing, but certainly some of the capital has found its way into this sector and made the environment relatively competitive. So I'd say, you know, really good deals have been trading in believe it or not, in the low to mid 5% range, which I would characterize as incredibly strong for this property type. Overall, we're probably looking, somewhere in kind of the low to mid 6% range, which again I would still characterize as a hot market. To put that into context, apartments overall are trading in kind of the high 5-ish range these days. So you're not seeing much of a premium or discount, depending upon which side of the ledger you're looking at, between seniors housing and apartment right now. So I think that speaks volumes about investor interest in the sector.
Wow, that is interesting. So I guess they're expecting a lot of upside in this area.
Yeah, I mean, there must be some, and rightfully so, as we've discussed.
Mm-hmm.
Clearly, there are a lot of good things for this property type going forward, and clearly, I think a lot of that is baked into these low cap rates.
Okay, we're talking with Ryan Severino with REIS about the senior housing market. And so, Ryan, what would you expect moving forward for cap rates, say, a year from now in this sector?
Sort of along the lines with our expectations for cap rates in general, I would expect to see cap rates continue to be low in the near term. Maybe not necessarily drifting too much lower. It's difficult to envision too much more cap rate compression, certainly relative to what we've observed up to this juncture, but I don't expect cap rates to begin rising, at least not over the next year or two. As we've been discussing, fundamentals for this sector will be strong for a while, so that will keep downward pressure on pricing, especially for the high-quality assets. So I think even if we do get some upward movement in short-term interest rates with the Fed over the next, say, 6 to 12 months, I think we will be in a low cap rate environment for that duration.
Okay, and you mentioned the various property types kind of under the senior housing hat there. Are there certain property types that investors are showing more interest in?
It really seems like, depending upon where you are in the country, some could be more favored than others. I think generally we've seen some money flowing into assisted living and some money flowing into independent living. I think where at least we've seen investors a little more cautious is some of the subsectors of the market where it tends to be a little more service intensive. Some of the skilled nursing care or memory care, just because then it really becomes truly more of an operating business. And while I can't say that I haven't seen money flowing into that, it just seems like in aggregate, investors who are interested in this sector but maybe don't have as much experience and they haven't gotten their hands as dirty as some others, haven't really been jumping into that deep end of the pool with both feet just yet.
Yeah, it certainly is a specialized sector, isn't it? So Ryan, what are some of the other factors that would impact this industry and this sector moving forward that, if you were an investor, that you might be concerned with as a possible headwind?
The real headwind that I see when I look at this market is affordability, in the sense that, the nicest properties out there, the ones that they're building with, the granite countertops and the really nice finishes and the infinity pools and lazy rivers and media rooms and all those really high-end amenities, they are incredibly expensive, especially for the subtypes, as I just mentioned, that do require a high level of service like skilled nursing and memory care. There are units for those, even beds in rooms for those, depending upon the part of the country that you're talking about, that can run you $12,000, $14,000, $16,000, $18,000 per month. Those units are really out of the reach of many, because the majority of households don't have that kind of saving. Not surprisingly, we tend to be undersaved in aggregate as a country, and a lot of households don't have long-term care insurance. And I hate to burst everyone's bubble, but Medicare is not going to pay to put grandma in that bright, shiny new center. It's more of the stereotypical kind of almost communist-era type seniors housing that I think most people have the connotation of when you think seniors housing. So there isn't a really good magic solution to this, because the level of service is paramount for the performance of the center, and we tend to pay for that. And so I know there are some organizations that are out there that are working on affordable solutions to higher-end centers. I think it will be really interesting to monitor and see if they succeed or not, but I don't think anybody's got a magic solution to this problem just yet.
Yeah, well, it's an interesting subject because it's touching all of us in some ways. It's our grandparents, our parents, or maybe us, headed towards these senior housing communities. But there's also some opportunities in the sector, aren't there?
Absolutely. I think, we talked a bit about the demographics, and that there is this demographic tidal wave that is going to be influencing the sector. And I think what often is sort of lost in some of the data about demographics is that if you're an American and you reach the age of 65, life expectancy for males is about 17 years, so it means they tend to live until your early 80s, and for women tends to be 21 to 22 years of age, so you tend to live until your late 80s. There are a lot of years between sort of that sort of early 70s inflection point where demand for these types of units starts to increase, and when people ultimately cease to use them, and we are going to see a lot of demand because the majority of us, myself included, are just not really trained and equipped to take care of elderly relatives. So we're going to have to outsource that.
Yeah, going to be a lot of upside for investors there, is what a lot of people are thinking. Well, Ryan, thanks for joining us today.
My pleasure as always, Michael. Thank you.
Well, stay tuned. We'll have more on this senior housing subject for you. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Advisors, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive and powerful suite of commercial real estate tools at an incredibly low price. Visit realnex.com. That's REALNEX. Xceligent, the resource professionals use for commercial real estate information. Visit xceligent.com. That's XCELIGENT. Commercial Search, the source to market and source available properties for sale or lease. Visit commercialsearch.com. For more information on these great companies or for additional videos, podcasts, or articles, visit CREshow.com.